Assalamu alaikum, dear students. I hope you all are fine and safe. I am Dr. S.M. Ali Tirmizi, your teacher and guide of Corporate Governance course. Today we will discuss chapter number 9, that is Executive Equity Ownership. The main topics that we will cover in this chapter are listed in the next slide. I hope you will find this video lecture useful to clear topics and concepts related to chapter number 9 of Corporate Governance. In this chapter, the major topics that we will cover starts with the introduction of the chapter. Then we will discuss the topic of equity ownership and firm performance. Third topic of this chapter is equity ownership and risk. Fourth one is equity ownership and agency costs. Fifth is accounting manipulation. Sixth is manipulation of equity grants. Seventh topic is equity sales and insider trading. Eighth is hedging. Ninth topic that we will discuss in this chapter is pledging, and 10th topic of this chapter is repricing and exchange offers. At the end of this lecture, I will discuss the article, reading assignment, as well as quiz details that is being uploaded on the Corporate Governance Microsoft Teams class platform. In this chapter class, you will examine the relationship between equity ownership and executive behavior. In theory, executives who hold equity in the companies either directly in the form of stock ownership or indirectly through options, restricted stock, and performance shares have greater incentive to improve the economic value of the firm. The executive equity ownership discourages self-interested behavior of the executives because if the action of the executives result into loss of the firm value, then it's obvious that the personal wealth of the executive will also be damaged. Therefore, in this context, executive equity ownership is an important tool that companies use to mitigate agency problems. Moreover, in this chapter, you will also examine and learn the potentially positive and negative effects of executive equity ownership. This is a topic relating equity ownership and firm performance. It's a fact that the executives who have been in their position for a number of years tend to accumulate a substantial investment in their companies by retaining vested equity awards or buying shares. It is mentioned in the book of Corporate Governance Does Matters, which I am teaching you, that based on a sample of 4,000 largest publicly traded US companies, that the median CEO holds an equity position in his or her company with a value of $14.9 million. The equity ownership levels vary with company size. Among the largest 100 companies, the median CEO holds equity wealth valued at $104.9 million. Among the smallest 1,000 companies in this sample, median wealth is $3.5 million. If we consider research conducted on this topic, research generally supports the notion that equity ownership is positively associated with firm performance. According to a study by Linfeld and Runze in 2014, the firms with high CEO ownership levels deliver higher stock market returns than firms with low managerial ownership. Thus, according to these authors, owner CEOs are value increasing and they reduce empire building and run their firms more efficiently. Now I'll discuss target ownership plans under the topic of equity ownership and firm performance. A target ownership plan requires that an executive own a minimum amount of company stock. The limit is generally expressed as a multiple of the annual salary and varies among executive officers depending on their seniority. For example, in 2014, Abbott Laboratories required that CEO Miles White hold stock and options with a value equal to 6 times his base salary of $1.9 million. Executive and senior vice presidents were required to hold 3 times base salary and all other officers 2 times. Now, linking equity ownership and firm performance, I'll discuss an example from Pakistan. So, this is an example of PPL. So, in this topic, we will discuss the example of Pakistan Petroleum Limited. The patron of shareholding as at June 30th, 2019 of PPL, 7.35%. Shares are held by the PPL Employees Empowerment Trust, 0.06% by PPL Employees Retirement Benefit Funds. Rest of the shares are held by other investors, where Government of Pakistan is holding 67.51% of PPL shares. So stakes of PPL employees have been linked with the PPL, and in this way, if company, that is Pakistan Petroleum Limited, grows, employees or executives' wealth also grows accordingly. Thus, this is a good example of equity ownership of employees or executives in the case of Pakistan. Now class, watch an online video relating the logic behind executive compensation, particularly when equity ownership is considered as a tool of executive compensation.
It's a fact. The most valuable asset a business or professional practice owns is not likely to be offices, equipment, inventory, or even its valued clients. A business's most valuable asset is invariably people, its valuable employees. Business success rests on the men and women who keep the operation running, the people who know what to do, when to do it, and how to get it done on time. That's why business and professional practices look to executive compensation as a means of attracting, rewarding, and retaining key executive talent. There's no question, executive compensation can play a key role in keeping organizations effective in today's highly competitive marketplace. Executive compensation helps in a number of ways: to recruit high-caliber talent, retain the people once they're on board, reward talent and service, replace benefits lost to qualified plan limitations, and when the time comes, retire key people. Look at the results of a survey conducted by a respected research organization. 60% of the firms contacted utilized various executive compensation techniques to attract, retain, and reward highly compensated people. Another 23% added executive compensation plans to improve the business owner's personal benefits. 4% experienced the need to match a competitor's benefit package. Another 5% said affordability was the primary motivator. In other words, they had the resources to add the benefit. 2% of the organizations added executive compensation because their key employees requested it. And finally, 6% reported using it for other reasons. There's another reason organizations use executive compensation. It levels the qualified retirement plan playing field. The fact is, contribution limits and discrimination rules mandated in qualified retirement plans tend to discriminate against highly compensated professionals.
Now the next topic, that is topic number 3 of the chapter, which I'm going to discuss with you, is relating equity ownership and risk. This topic is relating the level of risk an executive can bear while holding an equity portfolio in a company. Therefore, in this context, equity ownership not only provides incentive for performance, but also encourages risk-taking. So keep this valid or holds true. It is the responsibility of the board of directors to determine a company's risk tolerance and establish a compensation program consistent with view of the risk. Having said this, the composition of an executive's equity portfolios plays a considerable role in determining his or her appetite for risk. An executive whose wealth consists entirely of direct stock investments, either restricted shares or shares that have vested but not been sold, stands to gain or lose wealth dollar for dollar or rupees for rupees with changes in the stock price. Many boards like this arrangement because it is seen as putting the executive on equal footing with the average investor. However, in this case, the executive has a large, concentrated exposure to a single stock and therefore is exposed to greater personal financial risk. As a result, the executives have a tendency to become risk averse, and over time, this can reduce performance. So, here stock options can be used to counteract risk aversion of the executives. Stock options basically protects the executive stock investment where the value moves dollar for dollar with stock price when the option is in the money, which means when the stock price is above the exercise price. But when the value is unaffected by the stock price, which is basically the case when the option is out of money, which basically means when the stock price is below the exercise price. In these scenarios, boards must consider and decide executive compensation packages which do not lead to excessive risk taking behavior of the executives in the company. Now, under the topic of equity ownership and risk, I'll discuss example of executive compensation and the financial crisis of 2008. The most important question is, did the structure of executive compensation contracts cause the financial crisis of 2008? Conventional wisdom says yes. For example, a 2009 survey by KPMG found that 52% of senior managers at large financial institutions believe that incentives and remuneration were most at fault in contributing to the credit crisis. Similarly, a 2008 PricewaterhouseCoopers survey of financial services professionals found that the three most frequently cited factors that created the conditions for the crisis were: number one, 73% was the culture and excessive risk taking. Again, 73% was mispricing of risk, and 70% was the reward system. So, according to the facts being presented by this survey, excessive compensation is linked with the financial crisis of 2008. Now we'll discuss fourth topic of this chapter, that is equity ownership and agency cost. This topic is relating undesirable behavior of the executives that arises due to equity ownership, which motivates executives to divert away from the objectives of the company. This occurs when an executive seeks to increase the value of equity holdings in ways other than through improvements in operating, financing, and investment decisions. For example, manipulating accounting results to inflate stock price or achieve bonus targets, or using inside information to gain an advantage in selling or otherwise hedging equity holdings. Therefore, when these undesirable actions occur, they represent the very agency cost that equity ownership is intended to discourage in an organization. Now we'll discuss fifth topic of the chapter, that is accounting manipulation. There is a plenty of fraudulent evidence available that shows accounting manipulation occur. For example, executives of Enron front-loaded revenues and hid liabilities through off-balance sheet activities. On the other hand, the executives of WorldCom capitalized expenses on the balance sheet, which should have been traded as operating cost. However, in the case of Royal Dutch Shell, executives inflated the size and value of proved oil reserves. These facts show that large executive compensation in terms of equity ownership may lead to accounting manipulation, but the research evidence rating executives' holdings of large or small portion of company stocks is mixed. Now I'll discuss the sixth topic of this chapter, that is manipulation of equity grants. This topic is relating executives' manipulation of equity grants during the time when they have equity ownership, and this act is to extract incremental value. The manipulation of equity grants might occur in at least two ways. Number one, manipulating the timing of the grant. Number two is manipulating the timing of information released to the public. In the case of manipulation of timing of the grant date either is delayed so that it occurs after a stock price decline has already taken place or is brought forward to precede an expected increase in stock price. On the other hand, in the case of manipulation of timing of information released to the public, the release of favorable information about the company is delayed so that it occurs after a scheduled grant date. This information of the company could be related to a new product, a new strategic relationship in the industry, stronger than expected sales, etc. Therefore, executives in these situations get benefit by an immediate increase in value when the favorable information is released in the market. Likewise, unfavorable information is released early to precede a grant date. The executive in this case also benefits by receiving the grant after the unfavorable news has already driven the stock price lower. In both these cases, the executive seeks to maximize the value received from an equity grant by taking actions that are not in the interest of the shareholders of the company. According to the study of Lee in 2005, executives also manipulate the timing of awards in their favor, and this practice is known as stock option backdating. Now class, watch an online video relating Volkswagen CEO and chairman who were charged for market manipulation in Germany.
Shares of Volkswagen are falling after the company's top leaders were charged with market manipulation in Germany. Benedict Kamel has more. Walk us through what we know.
So we heard from prosecutors in Germany about an hour ago that indeed they have charged Herbert Diess. He is the CEO of Volkswagen, alongside the chairman and the ex-CEO Martin Winterkorn, who led the company at the time that this diesel scandal erupted. To remind people, this is 4 years ago this month, and the question really is, did management inform markets, investors early enough when they found out about this, or did they delay this? And as the court finds now, or the allegation is that they did come to the market too late. Investors lost a lot of money because of this, and they should have been quicker to come out with this ruling. Or with this information. Volkswagen themselves say today, we did nothing wrong. The company acted lawfully. They acted as quickly as they could. So it'll be interesting to see when and if this goes to trial, and how Volkswagen, and in particular Herbert Diess, the CEO, gets out of this. As you mentioned, the stock is under pressure now. Investors do like Herbert Diess at the helm of this company, and they don't really want to see him go. So it'll be interesting to see how he can navigate through this.
The seventh topic of this chapter is equity sales and insider trading. It's a fact that executives can diversify their equity holdings by making open market sales of company stock or by exercising stock options and selling the acquired shares. However, because executives have access to non-public information that could be materialized to value the company's stock, there is always a possibility that executives will use this information to gain an improper trading advantage over public shareholders. Therefore, in these cases, executives are the insider, identified as corporate officers, directors, employees, and certain professional advisors. So, trades made by these insider executives on the basis of financial and operational information about a company are considered illegal inside trading, and according to law, it's a punishable offense. Thus, to restrict executives from violating insider trading laws, companies typically designate a period of time known as blackout period, in which insiders, which are the executives, are restricted from making trades in the company stock. Now we will discuss the eighth topic of this chapter, which is hedging. Hedging here is protecting the risk associated with the investment in a particular share by the executives, and they basically take short position, which means short sell the company's shares by buying put option on company stock. Therefore, in this situation, an executive might decide to hedge the value of his or her equity holdings rather than engaging in an outright sale of shares or options. However, according to a data from Institutional Shareholder Services, 54% of companies in the Russell 3000 and 84% of companies in the S&P 500 have a policy prohibiting executives from hedging. Now I'll discuss hedging example with you, that is letting zero collar cost collar. The executive purchases a put option with an exercise price at or slightly below the current market price of the stock. The executive offsets the cost of the put option by selling a call option with an exercise price generally 10 to 20% above the current market price. The executive has effectively reduced the downside risk and has given up much of the upside gains. In economic substance, the collar is similar to a sale, although taxes are not owed until option expiration and the eventual stock sale. The executive can also take out a loan against the value of the collar and invest the proceeds in a diversified portfolio. Now, in the topic relating hedging policies and disclosure, I'll discuss an example relating Delta Airlines. As part of an update to its insider trading policy in 2012, Delta Airlines expanded and clarified prohibitions related to transactions in short term or highly leveraged transactions. Under the updated policy, Delta Airlines prohibits employees from engaging in transactions in Delta securities involving publicly traded options, short sales, and hedging transactions because they may create the appearance of unlawful insider trading and, in certain circumstances, present a conflict of interest. In addition, Delta Airlines expanded its insider trading policy to prohibit employees from holding Delta securities in a margin account or otherwise pledging Delta securities as collateral for a loan. Now I'll discuss ninth topic of this chapter, that is pledging. Instead of selling or hedging, an executive might decide to pledge shares as collateral for a loan, with the proceeds used either to purchase a diversified portfolio of assets, to enter new business activities, or for personal spending. According to survey data, approximately 20% of companies in the world allow their executive to pledge shares. Now class, watch an online video relating how securities are pledged practically online.
Meet Benjamin, David, and Elizabeth. They all own stock in public companies with bright futures and good prospects for capital appreciation. They want to keep their stock, gain capital appreciation, and benefit from dividends. These stock owners also want to raise cash. Benjamin has his eye on another stock that he believes is a good investment. David is looking to buy real estate, and Elizabeth is starting a new business. They all have valuable public company stock that they don't want to sell, but they have immediate cash needs. WorldwideStockLoans.com can help solve this dilemma. Some of the stock that our friends own is not marginable through brokers, and some of our friends don't want the hassle of getting nasty margin calls. They don't want to put any of their other assets on the line, and they don't want somebody going through their tax returns, checking credit histories, or demanding projections, appraisals, or business plans. Our loans are non-recourse. The only collateral is the stock itself, and there are no personal guarantees or no upfront fees required. Most stocks listed on major world exchanges will qualify, providing the stock is free trading, non-restricted, and trades a minimum volume of $30,000 daily. We lend up to 80% of the security's value. Loans start at $100,000 and go all the way up to $500 million. Low interest fixed rates range from 3.5% to 6%. Term lengths are 2 to 10 years with quarterly interest only or deferred payment options. Our friends are busy. They like crisp, efficient, and timely dealings, and they want privacy and confidentiality. WorldwideStockLoans.com provides fast, private, and hassle-free lending. Most applicants get a term sheet within a day or two of applying. Once we have all the information, loan disbursements happen in a matter of days. Get your cash fast, use it for any purpose, and don't risk other assets. Talk to us today. We have done hundreds of stock loans reaching into the billions of dollars over the last 35 years. Go to worldwidestocklloans.com, fill in the 2-minute application, and request a quote now.
The last topic of this chapter is letting repricing and exchange offers. A repricing or exchange offer is a transaction in which employees holding stock options are allowed to exchange those options for either a new option, restricted stock, or cash. If approved by the shareholders of the company, the exchange may be made at a premium to fair value, at fair value, or at a discounted to fair value. Now class, we have completed all the topics of chapter number 9. And now I'll move towards article reading assignment that you have to complete on Microsoft Teams. So what you have to do is, you have to go to Microsoft Teams Corporate Governance class platform, and you have to read the article 9.9. The topic of the article 9.9 is every employee an owner really. And this article is letting Harvard Business Review, which I have already uploaded on the Microsoft Teams Corporate Governance class platform. So after reading this article, you have to use Microsoft Word Online and type one-page article review in your own words, and then you have to turn it in under assignment tabs. The submission deadline of submission of this article 9.9 is also been mentioned on Microsoft Teams. The quiz of chapter number 9 will be online between 8th to 11th June 2020. One more thing. In chapter number 8, I have discussed an example relating Kroger. So your task is pending relating the assignment submission of Kroger. So that was the task related to your visit to the official website of Kroger, and you have to write about their current practices relating executive compensation. You have to submit this assignment before submission of article 9.9 reading assignment. This is the end of lecture number 9, and I hope you have understood all the topics and concepts that we have studied in this lecture. Inshallah, I'll see you in the next lecture relating chapter number 10. Thank you and Allah Hafiz.